In this video, I want to consider how investor sentiments, shape stock market trends. How does investor sentiment affect the stock markets? And so, investor sentiment refers to the overall mood or the attitude of of investors towards the market or a particular security. It plays a significant role in driving stock market trends, often beyond fundamental factors like earning or economic data. It's surprising that, sentiments can even, affect the market because these are human beings. The players in the market are human beings and they're affected by emotions, sometimes. And so here are, how investor sentiments, influences market movements. Number one is bull markets and optimism. Bull markets and optimism. So during periods of optimism, investors have a positive outlook. All right. So optimism actually will generate positive outlook, leading to increased buying activities, and this drives up stock prices and fuel, bull markets, often characterized by strong upward trends and high trading volumes. So number two is bear markets and pessimism. We've considered bull market and optimism. We want to look at number two, bear market and pessimisms. So when sentiment turns negative, it does because it cannot continue to be positive, all through. It turns negative at a particular point, So when fear and uncertainty tends to dominate the market, it leads to, overall, it leads to kind of widespread selling. People will start dumping their stocks. So these drive down stock prices, resulting in bear markets marked by prolonged price declines and reduced investor confidence. Number three is overreaction. Number three is overreactions. So in a place where you have an overbought conditions, excessive optimism can leads, it can push stock prices beyond their intrinsic value, creating, speculative bubble. People will keep on buying, bidding up the price to a level that could be considered overvalued. Let's also look at oversold conditions. So excessive pessimism, may cause stocks to drop below their fair value, presenting, buying opportunities for contrarian investors. So these are pure, sentimental plays here, almost like neglecting company fundamentals. Pessimism and optimism, are like wreaking havoc, in the market, depending on, So number four is role of news and media. We live in an age, in an era where you are bombarded by information. There's that information overload. So news headlines, economic reports, and geographical events can significantly sway investor sentiments. Positive news often leads to bullish trend, while negative news can trigger bearish reaction, regardless of the underlying company fundamentals. This is serious. This is serious. So please subscribe to this channel and like this video, and you can comment in the comment section. It will do me tons of good. Number five is heart mentality. Heart mentality. Investors often follow the crowd, leading to a kind of hard behavior. This can amplify market trends as people buy during rallies and sell during downturns, further accelerating price movements. Number six, influence of fear and greed. Influence of fear and greed. So in a case where there's that persistent fear, fear amongst market participants, you discover that during market downturn, fear can lead to panic selling, causing sharp price decline. It will cause the stock of the stock, it will cause stock prices to plummet. And also greed. We should not forget greed. Greed, in a rising market, greed drives speculative buying, pushing stock prices higher and sometimes leading to unsustainable valuation. They keep on buying, with the expectation that the market will keep on going high. And this is a typical influence of greed. Number 7 is sentiment indicators. Sentiment indicators. Number 7. So sentiment can be measured using various indicators. You have the volatility index. VIX, volatility index, is a very important parameter for measuring sentiments. It's often called the fear gauge. The fear gauge. It measures market volatility, expectations. You equally have, investor surveys, polls gauge investor confidence, providing insight into future market trends. Just surveying and sampling opinions of, or from investors, investor confidence with them, provides insights. This puts, to call ratio. So high ratio indicates bearish sentiments, while low ratios, suggest bullish sentiments. This pool, puts and call. You don't really have this functionality in the Nigerian market yet, but it's prevalent in advanced countries. Number 8 is short-term versus long-term impact. The short-term versus long-term impact of investor sentiments. So let's consider the short-term impact. So sentiments often drive short-term price fluctuations, leading to volatility. So in the short-term frame, you discover that it will impact, market volatility. But in the long term, over time, fundamentals tend to override sentiments, aligning stock prices with intrinsic value. In the long term, you discover that sentiments may not really have a major impact, actually. In the long run, it doesn't really count more. But in the short term, sentiments are, tends to affect the markets. So in conclusion, investor sentiment is a powerful force in shaping stock market trends. The entire thing is still it still amuses me. How would somebody, how would an investor, and these are educated, individuals, educated, sophisticated, intelligent, experienced, skilled individuals, we just allow sentiments to govern their behavior. It's something I find very difficult to fathom, to understand up till now. Personally, I don't invest based on sentiment. I just look at the earnings directly and consider other fundamental factors and initiate my buying or selling decisions. I don't consider sentiments at all. So while it may not always align with fundamentals, understanding sentiments can help investors anticipate market movements, manage risk, and identify opportunities during periods of excessive, optimism or fear. Optimism, pessimism, fear, greed, all these things, tend to affect the markets. Well, it's good. You may not really invest based on sentiment, but it's good you understand, how sentiments, influence stock prices.